Hi guys, welcome to this video. Today I'm going to be explaining a bit about the recent mini budget that's been going through and the implications that's going to have for the UK economy. It's really great information to know generally, but also if you're sitting exams and you're studying A-level or IB economics, this is really great information to apply in those exams. So we'll pay some special attention to application. Now, what did we see then? So what was this mini budget? The mini budget then was the first statement by Kwasi Kwarteng, who's the new Chancellor of the Exchequer following Liz Truss's ascension to Prime Minister. So what did this include? Well, this was the highest tax rate cut in 37 years. So it is an extraordinarily large cut to taxes. And one of the criticisms so far of this is these taxes has mainly been for businesses and for high net worth individuals. So for example, the top rate of tax, the 45% rate of taxes in the UK is going to be scrapped entirely. We're also going to see corporation tax frozen at 19% rather than being raised to 25%. And additionally, we're going to see a scrap in the raise of the national insurance contribution. What is the effect of this? Well, this is a massive tax cut. So what is the implications then? So it's probably fair if we start with what they were hoping to achieve. So what did they want from this? Well, if we look at some of the problems facing the UK economy right now, we have massive cost push inflation. So if we show this on the diagram, we'd have GDP, our price level. We're going to use a Keynesian diagram here, LRAS, AD. Now, just pause the video here and just have a think. How will we show the type of inflation we have in the UK right now then? We're going to have our Y1 and our P1. Now, just to note, I've drawn the UK around this point on this Keynesian supply curve. The reason for that is because the UK is quite a developed economy. It probably is using quite a lot of its productive potential, so it's likely to be operating on the inelastic section of the Keynesian curve. What we've then seen is as a result of war in Ukraine, but also as a result of supply disruption from COVID. Look at, for example, the cost of shipping, which still hasn't returned to pre-COVID levels. We're going to see a shift in LRS like this. And this then explains what we're seeing in the UK at the moment, where we follow the new equilibrium down. We get Y2, which is showing us negative growth, so it's showing us going into recession, which is backed by the statistics at the moment, and also a rise in price level to P2. So we've seen inflation. So the UK government were basically hoping here by cutting taxes that they could stimulate the economy and crucially to stimulate GDP. The way they were hoping to do this was through supply side policies. So what they're kind of hoping is that businesses will take the extra profits that they have and high net worth individuals will take their extra income and they'll reinvest this back into the UK economy. The effects of that would then be that our long run aggregate supply would shift back outwards, and that would then lead to a new equilibrium. So the way we would show this on the diagram is we could then show an outward shift in the LRS like this to LRAS3. That might be a little bit small for you guys, but I hope you can see it. And what's that then going to create is a new equilibrium. So we should see then a fall in inflation down to P3. So that's going to show us that we've actually had a fall in the rate of inflation. Although crucially note that originally we had price levels of P1 here, but now we have P3, which is still above P1. So even in the best world scenario, depending on how big this shift would be, if it went further than the original LRAS, we'd likely see a fall in prices. So we'd see deflation going on. Here we still have deflation, but it still means that the prices are higher than they would be before the backward shift caused by war and supply chain disruptions. Additionally then to GDP, you do of course see your rise in GDP down to Y3. So again, we shift outwards, but again, we're not back to the levels we were, say, pre-pandemic or pre-supply chain shocks. So this is what the government were hoping to do. What's actually happened then, and what has this actually caused? So the major impact, as you're probably well aware of watching this video, is there's been a massive depreciation in the pound. So why has that happened then? Let's have a think about this. So we already have a time of high inflation. And what the Chancellor is doing now is he is cutting taxes. So what's the first immediate effect of this going to be? If you're someone who was usually getting taxed at 45% and you now retain more of your money because of that tax cut, what is the most likely thing you're going to do with that money? Now, I think it would be fair to say that you're probably going to spend some of that extra money. This, of course, would depend on your marginal propensity to consume, so how likely you are to consume with that extra income, and your marginal propensity to save or withdraw. So how much of that money you're going to take away and save, and how much of that money you're going to take away and withdraw from the economy altogether. So that could be, for example, shifting it to another country. If we say then that the large majority of people are probably going to use this money for consumption when they get this additional income, that's going to have a strange effect. Because again, if we now look in the short run, GDP price levels, we have short run aggregate supply now, and we have AD here. We know that as a component of AD, we have consumption plus investment plus government spending plus the function of X minus M, which is exports minus imports, so our trade balance. Now, we know that at first, the consumption element is going to increase here, so people are going to be spending more money. Additionally, even if the Chancellor's plan works and they do start to invest, remember we have the I function of AD, which is also going to then lead to a boost in aggregate demand. So aggregate demand will shift to the right. This will then lead to a rise in price levels and admittedly some growth. However, considering we're already at very high levels of inflation at 8% in August, it's probably higher for this month, it's highly likely that actually any gains in growth would be cut out by the inflationary gains. So Y2, P2. And this was the major issue. So a lot of the big city banks, a lot of analysts and economists believe that these tax cuts would not actually lead to growth, would not lead to sustainable development. Instead, it would lead to inflation. And why is that a problem? Well, this then goes on to our exchange rates. If you're an investor and you have a lot of money in the UK, you're probably quite concerned by this because remember, as inflation goes up, the real value of your money or the purchasing power of that money is going to go down. So it's highly likely that investors would seek one, either alternative investments, or they would seek two, to leave the country they're looking at. So if we go down the first route of alternative investments, the UK doesn't really have many of these at the moment. Property is at an all-time high, the stock market is additionally at an all-time high, and many businesses on that stock market are crucially facing massive issues with inflationary pressures. Their costs are rising substantially, which means actually they're not as appealing to investors because they cannot offer the same long-term prospects that they could have done, say, 10 or 20 years ago. On the flip side then, what's the other option for investors? Well, that's to withdraw from the economy and go somewhere else where there's higher returns or just safer, or just a place where it's safer for their money. So the go-to place for most, the go-to place is going to be the US dollar. Why is that? It's because it's a large world currency. It's the largest world currency. It's even called the world currency. And in addition to that, the US market is always very safe. There's very little risk there that, for example, the dollar will completely default or become completely valueless. So as a risk management activity, by moving your money into the US, you can feel a bit safer about that. So what's that going to look like then, and why has that led to massive issues in the UK economy? Well, we're going to have quantity down here. Again, now we're looking at an exchange rate diagram, so we're going to have the pound to the dollar. Now, we have demand, pound, supply. Oh, supply pound. Now, before the announcements, we were looking at around £1 bought you around $1.12-ish. So £1 buys you $1.12. What then happened is the Chancellor came out and he said, right, we're going to tax less, we're going to cut taxes, and as a result of that, people feared inflation, so they were moving their money out. Take a second now and have a think, what line are we going to see shift then? If people are moving their money out of the UK into the USA, which of these lines is going to shift? It's going to be the supply line. So there's going to be more supply of pounds on the market, being offered in exchange for dollars. So we're going to see a shift to the right of S pounds, so the supply of the pounds. This is then going to lead to a higher level of quantity at the new equilibrium, so more pounds being sold in exchange for dollars. And additionally, it's going to lead to a depreciation. And at one point, we saw the pound as low as $1, and I believe it was 3 cents. So a massive depreciation there. What is the impact of this depreciation, and why is it so significant? Well, we trade a lot with the USA. So if there's going to be a depreciation, that makes importing a lot more expensive. Remember at the start of this video, I mentioned that already British businesses are suffering from inflation. Well, if there is now higher costs because it costs more to import your raw resources or your factors of production, that is then going to lead to even higher levels of inflation because businesses would have to pass on this exchange rate costing more onto the end consumer in a higher end price. So this could lead to high levels of inflation in the UK. And again, don't you see how there's kind of a snowballing effect there, which is actually the exchange rate gets worse because of the tax cuts, which means that businesses have to charge more, which makes inflation worse, which means that more investors leave, which means the depreciation gets worse. So you have this kind of vicious cycle that could occur there. So if we looked at the statistics for trade, exports and imports, so the trade balance is quite close between the US and the UK. We export around $59.89 billion worth of goods, so we export that to the US, and we import around $59.69 billion worth of goods from the US. So there's only a little bit in between that's actually our trade imbalance, where we have a trade deficit with the USA. So what could actually happen here when we have a depreciation is what? Well, we're likely to actually see our exports become more competitive in the US because now the US consumer can buy more of our goods for less dollars, which means they can sell them for a lower price to their consumers, and that will then mean there's overall demand for our goods as well. If there's more exports, that should be an injection into the circular flow, which should then lead to long run growth. So that could happen as well. So it's kind of a bit up in the air here. However, the markets have very much responded saying this is going to be a bad thing. The overall pressure is going to be inflation. Now, remember, there are two sides to all stories in economics. So we have these two opposing arguments, inflation versus higher exports. What one's going to win? How do we determine that? This is a really important skill for exams, but also more generally when we're considering pieces of information. So one of the factors we might want to consider here is the Marshall-Lerner condition. So this is to do with the elasticity of demand for imports when a country experiences a depreciation. Okay, so the goods we buy from the USA, are they likely to have elastic or inelastic demand? Well, it's quite likely, in my opinion, that they're quite inelastic. They're probably goods that we require and need, they're necessity goods, and therefore we will continue to import them even if they become more expensive because of the depreciation, which actually means that the trade balance should get worse. So instead of actually seeing an improvement in the trade balance, in my opinion, it's more likely that we're going to see a worsening in the trade balance, and this actually leads to more leakages from the circular flow, and again, a decline in aggregate demand and therefore GDP. In addition to that, remember, the US is a big producer of gas and oil. And what are the resources that people in Europe are having an issue with getting hold of today? It's gas and oil. So the elasticity of those is probably very, very low. It's very, very inelastic. So good, bad, who really knows? You can discuss it in the comments below. There was a very interesting effect going on here that we do need to be aware of. So the budget came out last Friday, and then on Wednesday, there was nearly a market crash. The entire UK economy nearly crashed. I made a short form video explaining how the UK market nearly went into smithereens up here. So feel free to watch that. Also comment your opinions and your thoughts down below. Thank you for watching. I'll see you in the next one.